Something just happened in the gold market that changes everything. And I'm not talking about another all-time high. I'm talking about a structural shift that confirms what many have suspected for years. The fiat currency system as we know it is entering its final chapter. Let me show you exactly what I'm seeing, because the implications are staggering. Central banks just crossed a threshold that hasn't been crossed in over 4 decades. For the first time since the early 1980s, global central banks now hold more of their reserves in physical gold than in U.S. Treasury securities. Think about that for a moment. The very institutions that create and manage fiat currencies are systematically moving away from the world's reserve currency and into the one asset that has survived every monetary system collapse in human history. This isn't speculation. This is happening right now. In the past year alone, central banks purchased over 1,000 metric tons of gold. That's the equivalent of roughly 32 million troy ounces. To put that in perspective, that's more gold than most countries produce in an entire year. And they're not slowing down. They're accelerating. But here's where it gets really interesting. These aren't just any central banks. We're talking about the People's Bank of China, the Reserve Bank of India, the Central Bank of Turkey, the National Bank of Poland. These are major economic powers making a coordinated move away from dollar-denominated assets. They're not announcing it with press conferences. They're not making grand statements. They're just quietly, methodically, month after month, converting their dollar reserves into physical gold. Why now? What do they see that the average investor doesn't? Let me walk you through what's actually happening beneath the surface of these markets, because once you understand the mechanics, you'll see why this moment is so critical. The global monetary system operates on trust. That's it. There's no gold backing the dollar anymore. That ended in 1971 when Nixon closed the gold window. There's no commodity backing the euro, the yen, or any other major currency. It's all based on the collective belief that these pieces of paper, or more accurately, these digital entries in computer systems, will hold their value. But trust is a fragile thing. And right now, that trust is eroding faster than most people realize. Consider what's happened over just the past few years. The United States has added over $7 trillion to its national debt. That's not over a decade. That's in just a few years. The Federal Reserve's balance sheet exploded from under $1 trillion before 2008 to nearly $9 trillion at its peak. They've since reduced it somewhat, but the damage is done. Every major central bank has followed the same playbook: print money, buy assets, hope for the best. And here's the thing. It worked for a while. Asset prices went up. Stock markets hit record highs. Real estate boomed. Everyone felt wealthier. But that wealth was built on an expanding money supply, not on actual economic productivity. It was inflation masquerading as prosperity. Now the bill is coming due, and central banks know it. That's why they're buying gold. Not because they think it's going to double next year, though it might. They're buying gold because they need a monetary anchor that exists outside the fiat system. They need an asset that can't be printed, can't be digitally created, can't be inflated away by political decisions. Let me tell you a story that illustrates exactly what I'm talking about. In 1971, France did something that terrified the United States government. Under President Charles de Gaulle, France started converting its dollar reserves into physical gold at the official rate of $35 per ounce. They sent a warship to New York Harbor to pick up the gold. Not a cargo ship, a warship. They loaded up French gold and sailed it back to Paris. Why? Because de Gaulle understood something fundamental. He saw that the United States was printing more dollars than it had gold to back them. He saw the Vietnam War spending, the Great Society programs, the mounting deficits. And he realized that the dollar was overvalued relative to gold. So he did the rational thing. He exchanged his overvalued paper for undervalued metal. Other countries started to follow. Germany, Switzerland, others. They all wanted their gold. And that's when Nixon had no choice but to close the gold window entirely. He had to break the promise that had backed the dollar since Bretton Woods in 1944. He had to admit that the United States didn't have enough gold to honor its commitments. That moment in 1971 was supposed to be temporary. Nixon called it a temporary suspension, but temporary became permanent. And we've been living in a pure fiat currency world ever since. Now here we are, over 50 years later, and history is rhyming in a way that should make everyone pay attention. Central banks today are doing exactly what France did in 1971. They're looking at the dollar, they're looking at their reserves, and they're making a calculation. They're seeing the same warning signs: massive deficits, political dysfunction, a central bank that's trapped between inflation and recession, a currency that's overvalued relative to hard assets. But this time, There's no gold window to close. There's no official conversion rate. There's just the open market. And in the open market, gold is sending a very clear signal. Gold has been in a structural bull market since 2001. Yes, there have been corrections. Yes, there have been periods where it seemed to stall. But the long-term trend is unmistakable, from under $300 an ounce to recent highs above $2,000. That's not just inflation. That's a fundamental repricing of monetary risk. And the really interesting part, this bull market has happened despite massive headwinds. The gold market has been suppressed through paper derivatives, through central bank leasing programs, through coordinated selling at key technical levels. The COMEX futures market trades hundreds of times more paper gold than actual physical gold exists. It's a system designed to control the price, to prevent gold from signaling what it's really telling us about the health of the monetary system. But even with all that suppression, gold keeps rising. Because physical demand keeps overwhelming paper supply. Because central banks keep buying. Because wealthy individuals and institutions keep moving into physical metal. Let me give you some numbers that really drive this home. The COMEX, which is the major futures exchange for gold in the United States, has something called registered gold. That's gold that's available for delivery against futures contracts. Right now, that registered gold sits at historically low levels relative to the open interest in futures contracts. We're talking about a ratio that suggests there are claims on every ounce of physical gold that far exceed what's actually available. Now, most futures contracts don't result in physical delivery. Most traders just roll their contracts or settle in cash. But what happens if that changes? What happens if more contract holders start demanding physical delivery? What happens if the paper market breaks down because there's not enough physical metal to satisfy the claims? That's called a squeeze. And there are signs it might be starting. Look at what happened in the nickel market in early 2022. The London Metal Exchange had to halt trading and cancel trades because a massive short squeeze threatened to bankrupt major participants. They literally rewrote the rules in the middle of the game to prevent a complete market breakdown. If that can happen in nickel, what makes you think it can't happen in gold? The difference is, gold isn't just an industrial metal. Gold is money. It's the foundation of the entire monetary system, whether central banks want to admit it or not. A squeeze in the gold market wouldn't just be a trading event. It would be a monetary crisis. And that's exactly what central banks are preparing for by accumulating physical metal. Now, let me connect this to something that affects every person watching this, whether you own gold or not. Your retirement accounts, your savings, your purchasing power, all of it is denominated in fiat currency. If you have a 401k, it's invested in stocks and bonds that are priced in dollars. If you have a pension, it's a promise to pay you dollars in the future. If you have cash in the bank, it's dollars sitting in an account. What happens to all of that if the dollar loses its status as the world's reserve currency? What happens if central banks continue moving away from dollar reserves and into gold? What happens if other countries start demanding payment for oil, for commodities, for goods, and something other than dollars? The answer is inflation. Not the 2 or 3% inflation that central banks target. Real inflation. The kind that destroys purchasing power, that makes retirement savings inadequate, that forces people to work years longer than they planned. We've already seen a preview of this. Over the past few years, real inflation, the kind you experience at the grocery store, at the gas pump, in your utility bills, has been running far higher than official statistics suggest. The CPI might say 3 or 4%, but your actual cost of living has gone up 10, 15, 20%, depending on what you buy. That's the hidden tax of monetary debasement. That's what happens when central banks print money to finance government spending. The money supply expands, but the amount of goods and services doesn't expand at the same rate, so prices rise. It's not complicated economics, it's simple arithmetic. And gold is the thermometer that measures this fever. When gold rises, it's not really gold going up. It's the currency going down. Gold is just sitting there, being gold, the same as it's been for thousands of years. It's the paper currency that's losing value. Quick aside here, because this is relevant if you're sitting on a significant retirement account. If you have $100,000 or more in a traditional IRA or 401k, there's a way to get physical gold into that account without triggering taxes or penalties. It's called a gold IRA, and I put together a free guide that explains exactly how it works, the rules, the process, the pros and cons. It's in the description below. Worth looking at if you're concerned about the purchasing power of your retirement savings. No pressure, just information if it's relevant to your situation. All right, Back to what's happening in the markets right now. The BRICS nations, Brazil, Russia, India, China, South Africa, have been openly discussing alternatives to the dollar for international trade. They're not just talking anymore, they're implementing. China and Russia are settling oil trades in yuan and rubles. India is buying Russian oil in rupees. Saudi Arabia is accepting yuan for oil sales to China. Each of these moves chips away at dollar demand. And when dollar demand falls, the value of existing dollars falls. It's supply and demand applied to currency. But here's what makes this moment different from previous challenges to dollar dominance. This time, there's a viable alternative that everyone can agree on. Not the yuan, China's currency isn't trusted enough. Not the euro, Europe has its own massive debt problems. Not a new BRICS currency, too complicated, too many competing interests. Gold, physical gold, the one asset that every central bank already holds, that has no counterparty risk, that can't be sanctioned or frozen, that has been money for 5,000 years. That's the reset that's coming. Not a formal announcement, not a new Bretton Woods conference. Just a gradual, then sudden shift where gold reasserts itself as the foundation of the monetary system, where currencies are once again measured against gold, even if not officially backed by it. And we're seeing the early stages of this right now. Look at the gold to silver ratio. Historically, this ratio has averaged somewhere between 50 and 60 to 1, meaning it takes 50 to 60 ounces of silver to equal the value of 1 ounce of gold. Right now, that ratio has been elevated, suggesting silver is undervalued relative to gold. But more importantly, both metals are rising together, which typically happens when there's a flight to monetary metals, not just to gold as a safe haven. Look at the mining stocks. Major gold producers have been underperforming the metal itself, which is unusual in a bull market. Normally, mining stocks leverage the gold price. They go up faster when gold rises. The fact that they're lagging suggests the market doesn't fully believe in this move yet, which means there's still significant upside when sentiment shifts. Look at the premiums on physical metal. If you try to buy gold coins or bars right now, you're paying significant premiums over the spot price. That spread between paper gold and physical gold is a stress indicator. It shows that people who want to own actual metal are willing to pay up because they don't trust the paper market to deliver. All of these are signs of a market in transition, a market that's moving from paper promises to physical assets, from trust in institutions to trust in tangible value. Let me tell you another story that illustrates where this could go. In 1980, gold hit an all-time high of $850 per ounce. In today's inflation-adjusted dollars, that's over $3,000. We're not there yet, which means either gold needs to rise significantly or we need to accept that the 1980 peak was an anomaly. But here's the thing. The conditions that drove gold to $850 in 1980 are actually worse today. Back then, the national debt was under $1 trillion. Today, it's over $35 trillion. Back then, the Fed's balance sheet was tiny. Today, it's massive. Back then, we had Paul Volcker willing to raise interest rates to 20% to break inflation. Today, we have a Fed that's terrified of recession and can't raise rates without crashing the economy. So if gold hit the equivalent of $3,000 in 1980 under better conditions, where should it be today under worse conditions? 4,000? 5,000? Higher? I'm not making a price prediction. I'm asking you to think about the logic. If gold is a measure of monetary stress, and monetary stress is higher now than it was in 1980, then gold is either going significantly higher or it's being artificially suppressed below its true value. Either way, the central banks buying at these levels are making a statement. They're saying that even at current prices, gold is undervalued relative to the risks in the fiat system. Now, let's talk about what happens next, because this is where it gets really interesting. There are essentially 3 scenarios for how this plays out. Scenario 1. The status quo continues. Central banks keep buying gold, but slowly. The dollar remains the reserve currency, but gradually loses market share. Gold rises steadily, but not dramatically. This is the soft landing scenario. It's possible, but it requires a level of coordination and restraint that's hard to imagine given the political and economic pressures we're seeing. Scenario 2. A crisis forces a reset. Maybe it's a debt crisis, maybe it's a currency crisis, maybe it's a geopolitical event. But something breaks, and suddenly everyone rushes for the exits at once. Gold spikes dramatically as people flee paper assets. This is the hard landing scenario. It's chaotic, it's painful, but it results in a new system that's more stable because it's based on something real. Scenario 3. A managed transition. Governments and central banks recognize what's happening and proactively move toward a gold-backed or gold-referenced system. They do it in an orderly way, with international cooperation, to minimize disruption. This is the best-case scenario, but also the least likely given the political realities. My guess? We're heading toward some combination of scenarios 2 and 3. There will be a crisis. There always is when systems change. But there will also be attempts to manage it, to control it, to make it as orderly as possible. And in that transition, gold will be the anchor. Not because governments want it to be, but because markets demand it. Because when trust in paper breaks down, people return to what has always worked. Here's what that means practically. If you own no gold, you're fully exposed to the fiat system. Your wealth is entirely dependent on the continued functioning and stability of paper currencies and the institutions that manage them. That might be fine. It might work out, but it's a concentrated risk. If you own some gold, you have a hedge. You have an asset that moves inversely to currency debasement. When the dollar weakens, gold typically strengthens. It's not perfect, nothing is, but it's a time-tested way to preserve purchasing power across monetary transitions. If you own a lot of gold, you're betting on a significant monetary reset. You're positioned for scenario 2 or 3. You might be early. These transitions take time. But if you're right about the direction, being early is better than being late. The question isn't whether gold is going up or down next week or next month. The question is whether the fiat monetary system can continue indefinitely without a gold anchor. And the central banks, through their actions, are telling us their answer. They're buying gold because they know what's coming. They're preparing for a world where currencies need to be backed by something real, something tangible, something that can't be printed into existence by political decree. You don't have to take my word for it. Just watch what they do, not what they say. Watch the monthly central bank purchase data. Watch the flow of physical gold from west to east. Watch the premiums on coins and bars. Watch the stress in the paper markets. The signs are all there. The confirmation is happening in real time. Gold isn't just going up because of inflation or geopolitical risk or any single factor. Gold is repricing because the monetary system itself is being repriced. This is the end of the pure fiat experiment that started in 1971. Not tomorrow, not next month, but over the next several years. We're watching a transition that happens maybe once or twice per century. The kind of transition that redefines wealth, that reshapes economies, that determines who preserves their purchasing power and who doesn't. And the fascinating thing? Most people aren't paying attention. They're focused on stock market moves, on interest rate decisions, on quarterly earnings reports, all of which matter in the short term, but none of which address the fundamental question. What happens when the currency itself becomes unreliable? That's the question central banks are answering with their gold purchases. That's the question you need to answer for yourself. Because this isn't just about making money on a gold trade. This is about preserving wealth across a monetary transition. This is about having a portion of your assets in something that will hold value regardless of what happens to paper currencies. The reset isn't coming. It's already here. It's happening slowly, then it will happen suddenly. And when it does, the people who position themselves ahead of time will be the ones who maintain their standard of living, who protect their families, who come out the other side intact. The central banks know this. That's why they're accumulating at record pace. That's why they're willing to buy at prices that seem high by historical standards. Because they're not looking at historical standards, they're looking at what's coming. And what's coming is a repricing of everything denominated in fiat currency. A repricing that favors hard assets over paper promises. A repricing that favors gold over dollars, euros, yen, or any other currency that can be created at will. This is the message the gold market is sending right now. This is what the central bank buying is confirming. The era of unlimited fiat currency creation is ending. Not because anyone decided it should end, but because the mathematics of debt and the physics of trust make it unsustainable. Gold is just telling us what's already true. The question is whether we're listening.